Hello everyone, welcome to another WPAT webinar. Today we're going to be talking about news and more specifically on the non-farm payroll. But before we move on, just remember that Forex and derivatives are traded on margin and this carries a significant amount of risk. So only trade the money you're willing to risk. We will be placing some possible pending orders today, and this is going to be done on a demo. So it's all for education purposes, and do not copy at home. Feel free to try to understand, go deeper on this before you actually start placing your own orders. So jumping to the actual news, I have here the economic calendar from MQ5. I like using it more for its simplicity. There are a lot of other websites out there. It's just that personal preference, I tend to use the MQ5. And we're here filtered for this week, the week of 31st of January until the 6th of February. And we'll see here that on Friday we have the non-farm payroll, which is one of, if not the most important news. Don't forget to like, subscribe, and activate the notifications so you can see more of this content. Now, why is news so important is because the way people react to the news will affect the market. Now, there's a misconception going on that people will say the news will impact the market. No, not really. The news, they don't trade. There is no actual impact from the news itself. What happens is, however, the traders will react to the news. That's what's going to impact the market. If the news is positive to a currency, then people tend to buy that currency, driving the price up. If a news is bad for the currency, then people sell the currency, driving the price down. But the actual news itself is not impacting the market directly. This is very important that we need to understand. So looking forward a little bit deeper on the non-farm, you see here that I've highlighted the forecast already. Why is this so important? It's because the difference in the forecast to the actual non-farm payroll, not only to the non-farm, but the difference between the forecast and what actually happens when the news comes is what's going to impact the market. So there's two things we have to check it. Number one is that if it's an increase from the previous, and if it's below or above the forecast. And this will tell us two things, right? Number one, if the forecast, if the number, the actual number here is the one released last non-farm, which was 7th of January. So if the number is below, the actual is below the forecast, then it's worse than they expected. So then the hype will go down, right? And if it's lower than the previous one, then that's when people will feel that the US dollars is not going to be as strong as it should. So then people will start selling it. Now, why the non-farm impacts so much? If you can read the text on the screen, but basically it's the payroll of everybody that's not working on the farms. So basically it says here, right? It covers 80% of the employees producing the entire GDP of the United States. So this is a good indication of how much income the Americans have it. And since they are such a strong economy, then that's why it starts to impact everything else. So what we're checking here is two things, right? Number one, the forecast for this Friday is already saying that it might drop. And the previous one was already in 199,000. So if the actual is below this 199, then what will happen is that the US dollars will get weaker. So this is going to be bad for the US dollars, causing the Euro USD to go up, which means that you need more dollars to buy the same amount of euros, and the USD JPY to go down because you need less JPY to buy the same amount of the US dollars. So that's how the news is translated directly on our charts. Now the opposite is also true. If the actual one is higher than the forecast and higher than the previous, then this brings a new optimistic feeling to the US dollars, where this is going to be very good for them, causing the Euro USD going down, which means that we need less US dollars to buy the same amount of euros. and the USD JPY to go up, which means you need more JPY to buy the same amount of dollars. And again, this is not caused by the news itself. It's more caused about how the traders will be seeing it. This is good for the USD. Then USD it's a sell. USD JPY it's a buy. That's how the traders will actually read this. Jumping directly to the MT4. This red line you guys see here, this is 5 minutes before the last non-farm payroll that happened last week. And you see that the volume here is how many times the price changed. And we had a very low price going more or less 256 times that the price changed here in average, jumping all the way to when the non-farm dropped to 1,386 price change in 1 single minute. Right? And this is only what's registered on the liquidity provider for the specific broker, not on what happened on the actual market. But then it gives you a good idea. Let me move the line out of the way so you guys can see how this affected the volume here below. And then on the chart itself, you had a huge growth on the first minute and then a huge drop on the second minute. And then everything gets a little bit chaotic, a lot of long weeks. We have a gap here where there were no prices between these two candles. And then after a while, that's when the market starts to calm down and everything goes to normal. As you see here, the volume starts to slowly keep dropping until it goes back to a more normal situation, and almost as if this part here, which is the actual impact of the non-farm, almost as this never happens, right? It's very common for us to see this during news. It's a huge impact, and then everything goes on as nothing happens. Now, if you're more conservative like me, the advice would be just simply do not trade. If you have trades that are going on for a while in the market, then for a few days already, then this does not affect in the grand scheme of things. You see that let me just zoom out more. So you see that if you have an order, for example here, 3 hours below the non-farm, then the impact that will cause it's already kind of nullified, right? So this is the. So then again, the advice I would give is if you don't have any open orders, then personally I feel it's better to not do it, because there's no fundamentals, there's no technical. It's much more about the panicking and reaction and everything, right? But then if you do insist on trading, and again, I'm only trading on a demo account, and this is just for education purposes. I saw a lot of people, what they do is they do pending orders, right? So then if I go to my chart and then I right click, I have the trading, I can do a buy limit or sell stop below the price, right? And those are pending orders. If the price activate these prices, then the orders will enter the market. So then what we can do is, for example, we do a sell stop. I'm not gonna do on this account specific. Actually, give me 1 second. Let me go back to I'll go back to another demo where we can place the orders. I think it will be more visual for you. Okay, we're back on a demo, and of course we're recording ahead of time, right? The non-farm is gonna only happen on Friday, but then let's imagine that we're on the last 5 minutes before it actually happens, which is on the MT4 server. I believe we're gonna be at 15:30, so 3:30 p.m. our server time. So then what most people do is that this is the price, so then you put a buy limit on the top of the price. Let me place again, buy stop ahead of the price, and then a sell stop below the price. So then those are pending orders, they're not in the market. Let me show on the here. You see that they're below this gray line, so then they are not on the actual market. It's just that if the market activates, then this will be an order that's on the actual market. And then if the price starts to go up too much just before, then we just keep moving, you know, we keep following the price, so it doesn't activate before the price actually hits them. And I also saw a few EAs that they do that. They keep adjusting the pending orders for the buy and the sell together with the price. So only if there's a huge impact on the price, you activate. Then to exit this, we might want to do two things. One of them is we can set up the take profit and stop loss. We can decide how much do we want, like how much points do we want for take profit and the stop loss, or just leave it open, and then we can do the trailing stop that I explained a little bit on the last video, right? And then if the trailing stop will be interesting, because if the market goes strongly to one direction, then that's when the stop loss will keep following the price, and then only once the price returns, then that's when this order is closed. So then you can get a little bit more of the potential there. But then this strategy is not 100% perfect. We're gonna have one problem, which is I'm gonna go here, right click, properties, and then show S line, and then you're gonna see that now I have a red line here which represents my buy price. So then I have the white one, which is my sell price, and the red one is the white one is the sell price, the red one is the buy price. So what will happen is that during the non-farm, because there are so many people buying and selling at the same time, what will happen is that the buy order will start to go up, because you have, well, let me just adjust this line here. I don't want the ray, and I want a ticker so we can see better. So then what will happen is that the buy price will go up, and then let me do it another color so it's more visual. So it's white for our sell price. So then what will happen, this is what's going to happen on the non-farm, because people think it's going to be good thing and people think it's going to be bad. So the buy price will go up and activate our buy, and then the sell price will go down and activate the sell. And then what will happen is that the difference between the buy price and the sell price is the spread, and then this will cause our spreads to enlarge. And this happens on every single broker in the market, as long as they are reflecting the actual market. So the problem we're gonna have is that those orders, if there's a high chance that they're gonna be activated at the same time, and then because the spreads are so big, once you activate the buy price, we need the white line here to go back and then be above this line here to profit again. So then this is the risk that we have. Wait, I deleted everything. I just wanted to delete one of them. Yes, so delete this one. Yeah, so then that's the risk we have, right? Is activating both orders on a huge spread and then waiting the market to come back. And that's one of the main reasons I say that it's better to not trade, as a personal opinion, on the non-farm. But then again, if you do wish to trade or go deeper on any type of strategy, then research a little bit more, understand everything that's going on, and then you can make your own informed judgment.